this is going to be every successful business owner and entrepreneur in the most exciting YouTube, which is we're going to talk about taxes. So I'm here with my good friend Jacob Cohen, who owns Cohen CPA. Jacob, could you let everyone know about what you do, your background, and how you started the firm?
Sure. I'm a certified public accountant. Live in Philadelphia. Our firm's in Philadelphia. Started working with small businesses 10 years ago. Fast forward to now, we have 13 employees at the firm, do over 1,000 tax returns. A lot of high net worth individuals, real estate owners, developers, investors, etc.
So you specialize in real estate?
Correct.
Awesome. So my first question is, I just got this question from one of my friends who she did a very successful job as an engineer in New York City, just started this online business as an entrepreneur working for herself. And she just started making, let's say $300,000 a year. What advice would you give to the business owner / entrepreneur in structuring their taxes as a single member LLC? Just a quick overview.
First thing I would do is I make sure to form an LLC. Not all business owners do, but I'd form an LLC. And then secondary, I would elect for that LLC to be taxed as an S corp for federal and state tax purposes. There's going to be a lot of benefits in terms of paying less payroll taxes, Social Security and Medicare tax, while still staying within IRS rules.
So let's say someone makes a $300,000 profit. What would the tax savings be between that business owner just taking it in their own name, or whether they're paying themselves with a salary or just dividending out the money? How much money are they going to save?
Sure. So while all of the income will be subject to normal state and federal income taxes, in an S corporation setup, they can take a salary, a reasonable salary, which I would define reasonable if they're making $300,000 as at least, let's say, $80,000 to $100,000 salary. But then the remaining amount of the income is not going to be subject to any Social Security or Medicare tax. So big round numbers, they would save about, let's say $12,000 in Social Security and Medicare if they use the S corporation setup instead of just taking it all in their personal name.
I think just doing some quick math, the entrepreneur, taking a salary, dividending the rest of the money, not including state and local taxes. They would save $12,000 from having them dividend the rest of the money.
Sure, and each business is different depending on if they're in New York City or Philadelphia. There may be different rules, but this isn't tax evasion at all. This is a very legitimate way of doing business. And honestly, most accountants recommend business owners that make more than $100,000 to use this setup because of the tax savings.
That's incredible, and that's I would say something that it was recommended to me when I first got started, but I didn't even know the mechanics of how all that worked, which is pretty awesome.
Yeah, part of starting a business is you got to have a good accountant and a good lawyer, because often they can they'll save you more money than what they'll cost you in the long run.
So let's talk about the successful business owner that is looking to, I'd say, write more off or take advantage of tax write-offs. What advice would you give to them as to the best way to accomplish that?
Sure. The first thing I would do is make sure to be using a business bank account and business credit card and run everything through that you can. And then really the rules are flexible in terms of what is considered a business expense. The biggest thing is I would not assume that something is not deductible because you don't think it should be. I would ask your accountant or research it, because you might find that it is deductible. In fact, as an example, if you have clothing for your business that has your logo or the name of your business, then that buying that clothing and giving it out or wearing it could be deductible. While if we just wear a normal suit, you can't really charge that as a business expense. So
if you have Jacob Cohen CPA stitched on your jacket or some logo, or I have my suit, which is funny because I actually have Advanced Philly all over my suit. Would that be a tax deduction?
Yes.
Awesome.
I would, because it's considered really promotion of the business and advertising, marketing, and that's a reasonable business expense.
Awesome. Mm-hmm. How about other ways that business owners could, write more opportunities to write more things off, or just opportunities in the tax code to
Sure. I mean, especially in the age of COVID, everyone's using a home office. So the first thing I'd say is like go for the home office deduction if you do have a home office in your house or your apartment or your condo. Additionally, meals are very much deductible, and actually the IRS made the rules a lot more flexible. So often you can write off 100% of meals that incurred now, because basically restaurants were struggling during COVID, so they had rules that for this year, if you end up buying food from a restaurant because the restaurants needed it to stay afloat, they let you deduct all of that instead of where normally you would only deduct 50%.
Is that still for this year?
It is for this year, but unless they extend it, it is going to sunset pretty soon.
Okay, wow, that's interesting.
Yeah, so that's made a huge difference. A lot of our clients, spend $20,000, $30,000, $40,000 on meals and networking, and so if that's only 50% deductible versus 100, it's actually saving them thousands of dollars a year in tax.
Yeah, I think I know one client that spends at least $100,000.
Okay, I wonder who that might be.
So, what's your thought on buying versus renting?
As a tax advisor, I see all of the benefits of buying, in terms of renting. I mean, in general, if you rent a place, you're not building any equity. You're spending money that you're not getting back. There's very few benefits. With buying, you might be able to write off, deductions like mortgage interest and sometimes real estate taxes, but also obviously you get potentially the appreciation of the property. And so, from my perspective, obviously, unless there's a market downturn where real estate prices are declining, I see people do much better and become more build more wealth by buying rather than renting.
So, what else I think of for myself is I just locked in an interest rate of 7.25% on my primary home, but I'm curious as to what your thought on this is I'm looking at that is it's offsetting my ordinary income. So it'll just say, set 7.25%. I really look at that as my net payment is 3,625 because I'm writing off about like half that income and up to $750,000, of course. Mm-hmm. And if someone has an interest rate of 5%, then it's really like 2.5%, and so you're looking at delta of about like a 1.125%. And I think that most people that are smart investors can earn at least a 10% return on other investments, passive investments. And even if someone's active, where they're improving the value of properties or they're trading stocks and have insider information or however way that they're doing it, I think people can see much greater returns in that 1.125%. So what do you think of the way that I look at it?
Yeah, I'd say that even though mortgage rates obviously are going up right now, historically they're still low. I remember my parents telling me that they had an 11.5% interest rate when they bought our first home in the 1980s, where I grew up. And yeah, if you're able to deduct the mortgage interest, then it's really not like you're paying that high of a rate. The effective rate is lower. And yeah, by doing that, it gives you, you're able to save more cash to invest. And agreed, if you have opportunities to invest in real estate investments or other opportunities, like hopefully you can exceed that level that you're paying.
And what I would say is when buyers are looking at the monthly payment that they're buying for the home, they're looking at this like, all right, I'm paying $5,000 or $10,000 a month to buy the home, but they're not taking into consideration the net of writing off all the interest, which now, since rates have risen from, let's say, 3.5 to 6.5, that's a big shocking number, but I think the big advantage is writing off the mortgage interest of up to $750,000.
Right. Yeah. On the homes that are purchased now, you can write off interest on up to $750,000 of debt. Right. And part of those So part of those payments are the interest, which is deductible, but also part of those payments are principal that you're paying down the mortgage. So you're building equity in the home every month when you make that payment.
So I just started accumulating, let's say, like rental properties, within the last few years. I think one of the unique things about real estate compared to other assets is the assets produce income every single month that can offset the debt. But what's your thought on depreciating these assets or accelerating the depreciation, and how would someone go and do that?
Sure, that's a great question. Depreciation is something for rental properties that isn't optional. The IRS says you have to do it if you have rental. So I want to make that clear. We've picked up new clients over the years that didn't realize that you had to take depreciation, and it could actually be bad for you if you don't. Depreciation is something that basically as a taxable deduction lowers your basis in the property every year, but it's really a tax shelter. And so we see clients that have profitable rental properties where they're getting a couple $100 a month of net cash flow, but they still end up showing a loss or break even for tax purposes because of depreciation. So this is how the IRS, what the IRS allows, and so absolutely take advantage of it. And then one other thing you mentioned in terms of accelerated depreciation, the IRS has additional rules that let you write off certain assets in the first year. Not like a property or land or anything, but equipment or furniture or fixtures, appliances. And so I just wanted to be clear that that's another opportunity. If you have a good tax advisor in the first year buy a property, you might be able to get an immediate return on your investment because of these types of write-offs.
What is your recommendation to the entrepreneur or business owner that's debating whether they should purchase or lease vehicles?
That's a good question. One of the benefits of purchasing is that under current rules, as long as you use it a majority of the time for business purposes, you can take a tremendous write-off in the beginning. So if you're looking for an immediate tax benefit, I would definitely say buying probably makes the most sense. And you can get that large depreciation deduction, by the way, whether or not you finance it or not. If you pay all in cash or you finance half the car or 2/3 of the car, you can still get that big depreciation right off the first year. Leasing can make sense, if you think you're going to switch cars every 2 years, 3 years. So if you're that type of individual or business owner and you want a new car every 2 or 3 years, at the end the economics may work out better to lease. But if you're not sure, it's always good to get the big deduction right now.
I feel like the way that I look at that is when you're leasing, you're just kind of like throwing away the money, although you do get to write it off. But I feel like there are circumstances where I think very traditionally, like pre-COVID, you go buy a car, let's say like $100,000, and then within 3 years or whatever, that car is at $50,000. But now with the lack of supply, I have one of my buddies that bought, like, you can go buy a car, let's say at like $100,000, and even 3 years later, it's going at like 50 or 100,000 over sticker, and at least the car is holding value. So I think there's certain models out there, but I think in that circumstance, if you're buying something that's going to hold value, it could make sense to purchase over lease, just like traditional thinking, right?
Yeah, I agree. Things may be changing. I have clients that are driving out to Harrisburg to try to find cars right now because they can't find any cars here. And so if cars retain value, more than they have historically, then certainly that would be another reason to buy instead of lease.
So we live in the great city of Philadelphia, the city of brotherly love. I actually did not figure this out until this year, but can you explain the mechanics of this business city wage tax and how does it work?
Sure. So there is a city wage tax for both residents and non-residents of Philadelphia. The resident tax is, if you live in the city, no matter where you work, you have to pay the city wage tax, and the current rate's about 3.8%. For non-residents, if you live outside the city but you come in here and work, then you have to pay about roughly 3.4% as a wage tax. So it's only really about 0.4 lower. So that's high. It's one of the highest wage taxes in the country.
And so that's if your employer is Philadelphia-based or headquartered in Philadelphia. Let's say someone lives in the main line and they go work for American Airlines or Penn Drexel, and they don't live in the city, but they work in the city, they still have to pay that 3.4%.
Yeah, as long as they're coming into the city every day or almost every day for work, they do have to pay that non-resident rate.
But if they're working from home?
So it's different. If they're working from home, then the city of Philadelphia has rules that you may be able to only pay non-resident wage tax on some of your wages for when you're coming in. And even though they may withhold all of it because they have to, you may have an opportunity to submit a refund petition to try to get some of the money back as long as your employer will sign off on it.
Interesting. And what about for business owners? Like, let's say, someone owns like a local franchise Modell's or a restaurant across the street, or just a normal business that's headquartered in Philly. How does the profits on my friend that has a single member LLC that, let's say she wants to headquarter her company out of Philadelphia. What does that tax structure look like?
Sure. Yeah. If you're in Philadelphia, any employees you have that are working, from your office are going to be subject to the wage tax, either the resident or non-resident wage tax. Additionally, there's a city business tax that you have to pay, which depends on whether you have profits or not. But there's two parts. It's part of it is based on receipts, and part of it is based on profits. The bottom line is, if you have a very profitable city business, then the city business tax, it's called the BIRT, the BIRT, could become a significant expense and has to be planned for.
So that's a 6% expense, and you have to prepay the next year's worth of taxes, right?
Yeah, it could be a little over 6% a year, and they do make you prepay an estimate for next year. However, I will say that for new businesses, there are rules where they don't force you to prepay next year's estimate. And also, they do exclude the first $100,000 of revenue. So if you have a business that it's just you and you make $80,000 of revenue and a profit of $70,000, you're actually not going to be subject to that 6% tax.
Oh, wow.
You're just going to end up paying tax at the normal resident or non-resident rate on what's called the net profits return, which is a secondary return.
So the 4%, the 3.8%.
Yeah, if you're a resident, 3.8%.
Got it.
So, but if you're a business owner that, you make $500,000 a year and everything's in Philadelphia, the BIRT expense will be significant. I will say, though, that it is deductible, as a business expense, so you will get tax savings back because it's deductible.
So, just the 6% BIRT tax that how about the 4% school tax? Is that deductible?
Nope.
Got it.
Not, unfortunately, it's not.
So that just goes to the brilliant school system that we have.
Yeah, or other places. I think they want people to believe it's going to the schools, but I'm not so sure.
So what would be your biggest piece of advice to your client that's a business owner that, let's say, bringing in, let's say, $500,000 worth of profit, of how to structure their company, just like high level, what advice would you give to them?
I would talk with an accountant about your situation, whether you're in Philadelphia or not, or what state you're in, to see if S corporation, structuring makes sense, because it does for most businesses that are profitable. So I'd say for a business that makes $500,000 a year, it's pretty much always going to be worth it to be taxed as an S corp rather than just a disregarded LLC, or Schedule C on your personal return. I would talk to financial planners and advisors about retirement plans, because some of our clients put away over $100,000 a year for retirement as a business deduction, and it takes their return from where they would show $600,000 profit to $450,000, which is a huge difference, and they're able to stockpile money in their retirement accounts very aggressively.
What's the thought on that? If because I feel like so far we've had some of the lowest tax rates historically in the country, and I feel like they're only to go up with how much the country's in debt. Is there
Yeah.
Wouldn't it be better to pay the taxes now at the lowest historical tax rate, or I don't know? I'm just curious.
Yeah, I'd say it depends, but I agree that I think rates will go up, especially for the higher earners. I think it depends on your income. If you can save taxes at the highest current rates for federal plus PA plus local for retirement contributions, then if you're getting over 40% savings for what you're contributing, that's pretty good. If you're making a $50,000 retirement contribution, but you're saving $20,000 of tax by doing it, I think that's a pretty good outcome.
Yeah.
If you're only saving 20% of tax, then no, I don't think it's necessarily worth allocating a ton of money to only save that amount of tax.
Can you borrow against that retirement account?
You can take loans. Certain retirement accounts you can take loans from. Generally, accountants and financial advisors would probably say you shouldn't do that as like a rule of thumb. But you can take loans from certain retirement accounts and pay it back over time with imputed interest, or actual interest, without causing a problem.
Just because I feel like right now is almost the best time to go and invest money in the retirement accounts, because S&P was at, let's say, 4,700 at the peak. I didn't look at it today, but it's like the high 3,000s, and getting a 15% discount, and then if you can still use the cash to leverage, and put into other, distressed real estate assets that you're improving the value of.
Mm-hmm.
So
it's an aggressive way to do things. I mean, who knows if the market will go down more? I certainly hope not. But we've had clients take loans over the years from their retirement accounts and gotten good value from it. Not all accounts allow it, so you have to look at each one.
So thanks for all the insight. What if someone wants to get a hold of you for for your firm to help them out with taxes? What is the best way for them to get a hold of you?
Sure. I would take a look at our website, jcohencpa.com, Jacob Cohen and Company in Philadelphia. Again, we have 13 staff, a lot of other CPAs and accountants here as well, not just me. And just send us an email or a message through the website, and we take it from there.
Awesome.
Francis, it's great to see you.
Hey, always a pleasure.
Yeah.